Before you skip this video, stop for a second and listen carefully. This video has no visuals, no fast cuts, no animations to keep your attention. It's just words, and that's exactly why most people will leave. But the few who stay and actually listen till the end usually walk away with something valuable, something that can change how they think about money forever. So don't skip, don't open another app, just focus for a few minutes, because what you're about to hear is not entertainment. It's a real comparison that most people get completely wrong, and that mistake quietly costs them years of financial progress. Imagine two people starting their journey at the exact same point in life. Same age, same income, same city, same opportunities. There's no advantage, no special connection, no hidden luck. They both work regular jobs and manage to save up $50,000. Now comes the decision that will shape their financial future. For the next 20 years, one person decides to invest in real estate. They've heard all the success stories, how real estate creates wealth, how renters pay your mortgage, how property always goes up in value over time. It feels safe, proven, and smart. The second person takes a completely different approach. Instead of buying property, they invest the same $50,000 into a total stock market index fund. No excitement, no physical assets, no rent checks, just numbers on a screen, and a belief in long-term growth. Both feel confident, both think they made the better choice. But what actually happens over the next 20 years tells a very different story. Let's start from day one. The real estate investor uses the $50,000 as a 20% down payment to buy a $250,000 rental property. They take out a mortgage, which costs around $1,350 per month. They find a tenant who pays $1,900 in rent every month. On paper, that looks like a clean $550 profit. And this is exactly where most people stop thinking. They see the difference between rent and mortgage and assume that's the profit. It feels simple, predictable, and powerful. Meanwhile, the stock investor takes the same $50,000 and puts it into a broad market index fund. They also decide to invest an additional $400 every month automatically. No tenants, no property, no physical ownership, just a long-term plan. At this stage, if you ask most people who's winning, they would instantly say the real estate investor. After all, they have a house, they have rent coming in, and they can physically see their investments. The stock investor just has a number on a screen. It doesn't feel real. But here's where things start to shift, because the numbers most people look at in real estate are incomplete. Very quickly, reality begins to show up. The real estate investor realizes that the $550 monthly profit is not actually $550. Property taxes alone take around $3,000 per year. Insurance adds another $1,500. Maintenance is constant. Even if nothing major breaks, it still costs money to keep the property in good condition. On average, that's another $2,000 to $3,000 per year. Then come the unexpected costs. A water heater breaks, $1,200 gone. The roof needs repairs, another $2,500 or more. A tenant moves out, and now there's 1 month with no rent coming in. That's $1,900 lost instantly. When you factor all of this in, that $550 monthly profit can easily shrink down to $200, sometimes even less, and in certain months, it becomes negative. And then there's something most people don't talk about enough: time and stress. The real estate investor is now responsible for this property. They have to deal with tenants, handle complaints, manage repairs, and stay on top of everything. Even if it's not every day, it's always there in the background. It's not truly passive, it's a commitment. Meanwhile, the stock investor continues doing the same thing every month. They invest $400 automatically, regardless of what the market is doing. There are no phone calls, no emergencies, no repairs. The market goes up and down, but they stay consistent. In the beginning, it doesn't feel exciting. There's no visible progress, no big wins, just slow growth. But underneath that simplicity, something powerful is happening: compounding. By year 5, the difference starts becoming visible. The stock investor's portfolio grows to around $90,000 to $110,000, depending on market performance. It didn't happen overnight, but it happened steadily. The real estate investor, on the other hand, has built some equity in the property. Maybe the property value is increased to $280,000. That's a $30,000 gain. And this is where real estate shows its biggest strength: leverage. The investor controlled a $250,000 asset with only $50,000 of their own money. So when the value goes up, the gains are amplified. But even with this advantage, there's still a trade-off. The stock investor achieved their growth with almost zero effort. The real estate investor had to stay involved. They had to manage problems, deal with uncertainty, and handle responsibilities. This difference becomes more important over time, especially as life gets busier. By year 7, compounding really starts to accelerate. The stock portfolio now reaches around $130,000 to $150,000. Growth starts to feel faster, even though the strategy hasn't changed at all. The real estate investor is still growing as well, but their actual return after expenses might only be around 3% to 5% annually in terms of cash flow. The appreciation helps, but it's not guaranteed, and it's not easily accessible unless the property is sold or refinanced. At year 10, something surprising happens. Both investors are almost at the same level in terms of total wealth. The real estate investor might have around $170,000 to $190,000 in equity, while the stock investor's portfolio sits somewhere between $160,000 to $180,000. On paper, it looks like a tie, but the journey to reach this point has been completely different. One required time, effort, and stress. The other required patience and discipline. Now fast forward to year 20, where the long-term results become clear. The real estate property is now worth somewhere between $480,000 and $520,000. The mortgage is nearly paid off, which means most of the rental income now turns into actual profit. Over the years, the total cash flow might add up to around $60,000 to $100,000. It's a strong result. It's a real asset generating real income. On the other side, the stock investor's portfolio reaches around $450,000 to $500,000, assuming an average return of about 10%. Again, both are in a similar range. But here's the part most people overlook. If the stock investor had simply increased their monthly investment by just $200, making it $600 instead of $400, their portfolio would now exceed $600,000. No additional stress, no extra work, just a slightly higher contribution. This is where the real difference becomes clear. Real estate can build wealth, sometimes faster, especially with leverage, but it demands involvement. Stocks may feel slow in the beginning, but they require almost nothing from you except consistency and patience. Of course, both options come with risks. Stocks are volatile, markets crash, and if you panic and sell, you lose. That's why many people never actually benefit from long-term investing. They let emotions control their decisions. Real estate has different risks. Bad tenants can damage property. Unexpected repairs can be expensive. Selling a property takes time, and you can't always access your money when you need it. So which one wins? The honest answer is it depends on how you approach it. Real estate wins when you buy smart, manage efficiently, scale your portfolio, and treat it like a serious business. Stocks win when you stay consistent, keep investing regularly, ignore short-term noise, and allow compounding to do its job over time. But beyond all the numbers, there's a deeper question you need to ask yourself. What kind of life do you want while building wealth? Do you want something hands-on, where you're actively involved and potentially earning more through effort? Or do you want something simple, where your money grows quietly in the background while you focus on other things? Because at the end of 20 years, both paths can make you wealthy, but only one of them allows you to keep your time and peace of mind throughout the journey. And for many people, That's more valuable than the extra money itself. So don't just follow what sounds good. Don't just copy what others are doing. Run the numbers for yourself. Understand the trade-offs. And most importantly, choose the path that fits your life, not just your wallet. If you actually listen till this point, you're already ahead of most people. So take a second, like this video, comment house or stocks so I know what you believe in, and subscribe, because the truth is, the information that actually helps you grow is usually the information most people skip. This video is for educational purposes only and not financial advice. Always do your own research before making any investment decisions.